You do have to look at the performance over the last month and wonder, actually, is this a great buying opportunity?
Commodity prices have recovered a lot more than the lithium equities.
I think M&A is likely as the market has improved. Welcome back to another Rockstock Channel weekly recap. It's Thursday, July 2nd, 2 days ahead of America's 250th birthday, and a time, of course, to reflect on the month, the second quarter, the first half of the year, and for many of the companies we follow, the end of the Australian financial year. Joining us for the first time this week is our associate, Ben Hammond, who has a number of firsts over the past couple of weeks. He made his first site visit with Anson Resources, attended his first Fastmarkets conference in Las Vegas, and conducted his first company interview as part of our live lounge series, which we published as last week's Rockstock Recap, featuring Anson, Q2 Metals, Noah Lithium Brines, Surge Battery Metals, Lithium Ionic, and First Phosphate. Ben also prepares our RK Equity Scoreboards and will be sharing some of his views on what Mr. Market is telling us amidst all the red reflected in the latest June Lithium Scoreboard, which we posted on X through @RK Equity Rocks last night. Which reminds me to remind all our viewers and listeners to follow @RK Equity Rocks on X to get all our 15 RK Equity Scoreboards at the end of each month. And also to visit our website, rkequity.com, and register your email to receive our free monthly Lithium-ion Bull newsletter, which includes all these scoreboards as well. Matt, Ben, and I are still digesting all the content coming from the Fastmarkets conference in Las Vegas, and we're publishing a great deal of it. Please be sure to check out our interview with the 4 members of Galan Lithium's management team and board, our first in-depth conversation with Tom Benson in his new role as CEO of Lithium Africa, following distinguished leadership positions at Lithium Americas and Lithium Argentina, as well as the direct lithium extraction panel that I had the pleasure of moderating with Aramit, Vulcan Energy, and several other leading DLE developers. Before we begin, a reminder that we may talk about stocks today that we may own or for companies that subscribe to RK Equity Services. But everything we discuss today is for informational and educational purposes only. We are not financial advisors, and nothing you hear today should be considered investment advice. Please do your own research and read the disclaimer at the end of this video. I'd also like to thank our sponsor, Clean Elements, an investor group focused on providing growth capital for critical minerals developers focused on the energy transition. Clean Elements has invested over $30 million to date and is currently the largest shareholder of both Galan Lithium and Noah Lithium Brines, 2 companies developing high-grade lithium brine projects in Argentina. And with that, welcome back, Matt. It was great to see you last week in Las Vegas. You're back in your normal seat in London. Where should we begin?
Well, obviously, we could talk about Vegas, but I think one of the standouts for me, having had a chance to look through all the scorecards, is what a lousy month it's been for metals performance, not just in the lithium space, but really much wider afield. So I guess I'll throw the floor out to ask why that might be the case.
Okay, Debbie Downer, we could start there.
Well, then we can finish up with the more cheerful stuff, you see.
Yeah. Okay. But you're right. I was extremely bullish at the Fastmarkets conference. They're just seeing a lot of people. The vibe was much more positive. It wasn't, crazy positive, but it was a hell of a lot better than it was last year. But it's always frustrating when you have all of this energy and enthusiasm, and then you get back to your hotel and look at your stocks, and everything was kind of like going down last week. And it wasn't, you're right, just lithium. It was rare earth stocks and a number of others across the sector. So people have been asking me since I get back, like, what's happened? Why? I don't really know. I think a fair bit has to do with, the Strait of Hormuz and the Iran. We all thought it was over, but then it's not over. I think that had a lot to do with it. But But besides that, the employment numbers came out just now. They're okay. Inflation is not crazy, so I don't know, but broadly, I wish I, could have an answer. There has been historic, it's not a great answer to say sell in May and go away, or, kind of seasonality. In the mining world, there's often some selling after PDAC, which was in March. So we had a great first quarter. Everything was, broadly bullish. Last month was not great, but overall last quarter was not awesome. But I really don't have a great answer.
I mean, I think sell in May and go away is a reasonable answer. Seasonally, the metal space is not strong over the Northern Hemisphere summer. Volumes tend to drop away, liquidity tends to drop away in the space. I think in the lithium space in particular, we had a very strong first quarter, and then prices haven't really pushed on. I mean, they haven't collapsed. They've been flat in a trading range, but they haven't really pushed on. And maybe there's been sort of a little bit of disappointment in that space. But what's interesting is when you look, across the rest of the critical material space, and, if I look at the lithium performance, I think, well, on average, I guess stocks are down sort of 15 or 20% for the month. But if I look, for instance, into the rare earth space again, there are stocks with really big losses there, sort of 20-25% for a month, for some of the America's critical rare earth project stocks. Australia's been pretty weak. Some of the performers have been pretty weak. What is very interesting though in the rare earth space is that rare earth prices are not actually down. So NdPr prices actually performed quite strongly from the end of May to now. These are Chinese prices, obviously, but you've seen this sort of big correction in stock prices, but it's not really being sort of backed up by the performance. And when I look at the rest of the minor metal space, there's a little bit more variability in the minor metal space. I mean, some of the cesium stocks were actually up for the month. Some of the tin stocks were up for the month, but I look at antimony and it's absolutely horrific. But you do have to look at the performance over the last month and wonder, actually, is this a great buying opportunity?
That's a good question. We as I'm listening to you, because I haven't really looked at antimony and cesium and the like. I have looked at like the metals company. That's fallen below $5. Rare Earths Americas, which recently went public, broke through its IPO price. But gold, had its worst quarter in 13 years. Bitcoin has been a disaster. So I'm just wondering if a lot of the uptick in a lot of the metals, you had American, listed stocks, you had all this enthusiasm a year ago, following MP Materials, and there was a lot of momentum, even going into the beginning of the year with Forge, all the announcements in January and February. But there seems to be a little bit of a fatigue, across the mineral sector broadly, right? Copper, I don't think is doing well. Copper equity, as I saw Robert Friedland tweeting, are underperforming the copper price. Ben, you're going to call up in a minute. Lithium prices have not fallen that much, but lithium equities have fallen a lot more. So maybe are equities forward looking about the price, or is this somewhat, again, this trade? A lot of things were, you say, is it a buy opportunity? But a lot of things got like very highly valued, right? So did sentiment push up stocks a fair bit? I don't know. There's been elections coming up, midterm elections coming up. Critical minerals hasn't been, there have been some deals in rare earths for sure. We've been keeping track of a lot of them, but it hasn't been as front headline news as SpaceX and draining of money for that from the IPO perspective. I don't know. There's a lot of cross currents here. I don't really know, but fundamentally the key drivers, if I go back to the Fastmarkets conference, and a podcast I listened to after that, like CATL, and Dale Henderson from PLS, demand, right? If you think about demand, for battery materials in particular, it's very strong. And a main theme from the conference, was definitely energy storage and, for AI, for the military, for grid resilience and affordability, right? Those drivers, I think maybe it's seasonality, but I think those drivers are going to result in supported lithium prices. Again, I don't know about rare earths and some of these other dynamics, but I think a lot of it is thematic sentiment driven, right? There was we still believe in this super cycle, but as you said last year, Matt, I think repeatedly, in the last super cycle, the one in our formative years in the beginning of this century, even though it was in
I wish you wouldn't say that. That makes us sound so old.
So old, I know. But it was an 8 to 10 year trajectory, but there were lots of pullbacks like we just saw, in various quarters. It wasn't just a straight line up. There were many retracements of 20,
I think
30, 40%.
What's really interesting, though, when you look at the sort of material prices, is the exchange traded materials have generally been quite weak and lithium, but then the non-exchange traded materials are quite robust. And again, that makes me think that what we've seen in June is more of a sort of macro risk off trade rather than something that relates to the underlying fundamentals. I mean, if I look at the data that we track for BM Review, for instance, germanium prices are up 28% in the month. High purity alumina prices up 13%. NdPr oxide prices up 16%. DYTB was up over 20%. Cathode precursor prices up. Manganese sulfate prices up. So it's, yes, areas of that were weak. Yes, Chinese lithium prices were a little bit all over the place. Yes, spodumene concentrate prices did come down. But most of the sort of weakness was around the exchange traded commodities like gold and silver and aluminium and nickel. And again, that highlights to me that what you're seeing is like a risk off story rather than an issue regarding fundamental demand, which I think, from our point of view is a good result.
Okay, that's great to hear that so many of those other commodities prices you mentioned, are going up. But Ben, why don't you call up your summary that you put together to
Right.
in association with the RK Equity Lithium Scoreboard.
Right.
Okay, so this is something that is very nicely graphically represented. Ben, you put this together overnight. So why don't you walk us through that?
All right. So looking at the lithium scoreboard, looks like the main message is that commodity prices have recovered a lot more than the lithium equities. Looking at that bottom table there, commodity prices are up strongly year to date. We got carbonate up 36%, spodumene up 46%, hydroxide up 51%. So on average, the commodity prices are up 44%. But when we look at the companies, the total scoreboard is only up 4% year to date. So it seems that the market is not yet treating the commodity price rally as a guaranteed long-term recovery. Another thing to note is that not all companies were treated the same. It seems that the chemical producers held up a lot better. They are up 17% year to date, and they also fell the least on the month, only down 7%. So that could suggest that investors see the chemical producers as more stable and lower risk. And moving on to the spodumene guys, they are up 5% year to date. And looking at the emerging hard rock developers, they are the standout at 20% year to date. But the other emerging categories like Sediment, DLE, Solar, all those companies, they're still negative. So that could mean that the market is preferring the simpler, more familiar project types. So that's a classic testament to our mantra of keeping it simple, spodumene stupid. So the final point would be looking at the monthly performance. Commodity prices are down on the month, but equities have fallen even more. Looking at spodumene concentrate again, down 12% on the month, yet spodumene producers have fallen 21%. So could that perhaps be an overcorrection? So overall, it seems that although prices have improved, the equity market is still cautious, which leads to the question, if commodity prices are up 44% year to date, but the lithium equities are only up 4%, what evidence would we need to see before the market starts re-rating these companies? Or might the market be anticipating something?
Thanks, Ben. That's very interesting. One thing I would point out is on our chemical producers series, we've got quite a lot of domestic Chinese stocks in that series. And I noticed that over the last month, most of those have outperformed the rest of the Western listed stocks. So that could be one reason why the chemical producer series has outperformed on the month. Having said that, you would generally expect the large cap chemical producers to outperform the smaller cap sort of developers in a weak month. So it's maybe not just that.
Yeah, I'm looking at the one. I mean, you focused a lot on the year-to-date performance there, Ben. Looking at kind of like the 1 month, right? So the carbonate price is down 12%, spodumene price down 12%, and spodumene producers are down 21%. So a bit more on the spodumene producer side. But interesting on the year-to-date, the hard rock explorers are up 20%. That stands out to me. Everything else is down like a lot. So there definitely seems to be I mean, maybe it's discovery related, or maybe it's, in Western Australia, a number of the non-producers have rallied strongly, like Wildcat and Core, perhaps. But I guess, Matt, we often say commodity equities follow commodity prices, but actually commodity prices often follow commodity equities, right? The equities sometimes tell us something about where the price is going. And there's been a lot of talk about this CATL Shangzhou mine. And I think Haplo tweeted yesterday, news that it's now underway, but it's not just 35,000 tons. It's prospectively 100,000 tons. Do you have any comment on that?
Believe it when I see it, to tell you the truth. I mean, having gone to that area, the mines in that area, they're all in one hill. And the problem with the CATL mine is that they're sort of the Johnny come latelys of that ore body. And, the specific part of the ore body that they're mining is one of the lowest grade parts of the ore body. So, if they were to take, a 35,000 ton per year operation to 100,000 ton per year operation, the big question is where the hell they're going to put the tailings, because that's 3 times as much tailings as they were generating previously. And obviously, as we know, there was already a problem with the tailings recently. And then if they have found a way maybe to extract material from the process, like some of the other lipid-light producers do in that area, and sell it as byproducts, that would have required some quite significant changes to the mill and the concentrator to do that. So obviously they have had the best part of a year, maybe to do those changes. But I would be, very doubtful about the possibility of them going from, 0 to 100,000 tons a year off a standing start, because I think I would say that was practically impossible. I mean, obviously things do happen in China, but I would be really, really surprised if that happened. So, maybe they're saying they want to go to 100,000 tons a year, but I'm not convinced that that's actually going to be, viable with that asset. We will find out over time. But what's interesting is when the news came out that mine was restarting, the GFEX price actually went up. So you are sort of sitting there sort of scratching your head going, well, does everybody actually believe that mine is restarting or not. Maybe it's just another rumor, or maybe people are selling rumors and buying fact, or the opposite way around.
I think so.
But I mean,
seems that way.
Yeah, I mean, I think that your point about the equities preceding commodity prices is I think a really important point, because when we started in the industry in the early noughties, the equities did precede commodity prices. The equities ran probably 3 to 6 months ahead of the commodity prices in the cycle. But over the past sort of 5 to 10 years, we've seen that relationship break down. And often what we see now is that equities run concurrently with commodity prices. Commodity prices actually go up, and then the equities start to notice, and investors sort of pile into those sectors. So it would be really interesting if we were now seeing equities running ahead of commodity prices, seeing something like a correction in the markets that perhaps the commodity markets are not seeing at the moment. I think more realistically, we've had a major risk off event, and people are just sort of selling some of the winners of the last sort of 3 to 6 months, and not really worrying about the fundamentals.
There's a lot of discourse about bubbles, especially like in the Mag 7. I've just noticed, Jeremy Grantham of GMO, he's doing a tour of his book, like as, a perma bear. And I listened to, a good interview with him, on Bloomberg's Odd Lots. But, I thought that was useful. I think on X, he was a bit unfairly treated. There was, Andrew Ross Sorkin and Joe Kiernan. I think Joe Kiernan was basically just like laughing at him, like, you're always wrong and, whatever. But the guy has been a successful, value investor. His argument has always been reversion to mean. And, he's seen tech as overvalued for a long period of time. But I think in general, there is a lot of, it's not just him, there's many others who are looking at SpaceX's valuation and, what was in that S1 about mining asteroids and, data centers in space and many other things that you can't put a quantitative value on, just seem, very significant. There's also news, I don't know, about China, catching up on the AI race, open source model. There's a lot of discourse out there. AI is so dominant, right? As much as we, are supportive of this narrative of Halo, heavy assets, low obsolescence, or local operations, and too much money has gone into light asset tech, and more needs to flow through into hard asset, commodities, et cetera, and infrastructure. Tech still dominates, right? And the money is flowing, whatever, 75 billion into SpaceX. I think OpenAI and Anthropic. There's also a little bit of jitters that OpenAI's IPO might be delayed till next year. So, I keep coming back to we are in a super cycle, and in the last super cycle, there were quarters where, you had a second guess. It wasn't a straight line up. And those who bought, the dips, right? It's a secular, bear, within a cyclical bull, or whatever you call that, whatever. These are dips, retracements. I think the sector is still broadly way underowned, undervalued, underappreciated, and the generalist investor has barely, kind of started paying attention, to it, outside of, a couple of meme stocks, behavior and speculation that happened, due to, the U.S. government, writing checks to specific companies on U.S. listed stocks. So,
yeah, I mean, I think probably the only sort of risk to your view is obviously if we do get a recession towards the end of this year, beginning of next year. I mean, I completely agree with you about the long-term sort of secular bull market thematic. I think the biggest risk at the moment is a Western world recession, and obviously with the Strait of Hormuz now sort of reopened. The big question is how long it takes that oil to get out into the system. And President Trump actually admitted in a press conference, I think it was last week while we were at the conference, that he felt that key reserves, strategic reserves, were down to 4 weeks, and that if the strait hadn't reopened, then it may have been a big issue. So, I mean, I think the market is looking at the situation from a macro point of view, and maybe some money's being taken off the table. There's some seasonality at play as well, and I think maybe the market will sort of take the Northern Hemisphere summer off and come back in, at the end of August, beginning of September, and look to replay these thematics.
Okay. It's strategic lithium petroleum reserves are definitely an important thing. I mentioned Odd Lots earlier. I listened to another Odd Lots podcast, kind of recounting why didn't oil go to $200 as people were forecasting, 3 months ago. And the answer is they don't know. But a lot of it, was speculation that China may have released a lot. People don't know exactly how big their reserves are, and they don't know how much was released. But I think their imports of oil went down. I think they said like 5 million barrels a day, decrease into
That's
China.
my understanding as well. I understand that China released a lot of its strategic reserves, and that was the key reason why oil prices didn't go down, because that offset Chinese imports considerably, giving some breathing space into the markets. So I think, fair play to President Trump and the Chinese. And fingers crossed, we can get back to normal service over the next 6 to 12 months, because I think what's been happening over the last 4 or 5 months isn't really good for anyone.
No, let's hope these ceasefires or whatever, eventually they stick. But Iran is a tricky actor on the geopolitical stage, I would say. Okay, so to be seen. One thing while we were away, there was a G7 communique from France. I haven't, fully digested that, but it did kind of reinforce the importance of reshoring, among Western allies. I think they made some commitments to, a specific, quantum. I forget exactly what they said, and I'll look into that. But I want to make a link from that G7 in France to what we heard in Las Vegas, was a lot of French language, out of the mouth of Rio Tinto's Jerome Pécresse, as well as Aramet, which were two highlights there. So I posted on X, some takeaways of Rio, because they were a platinum sponsor, but also the first time that the head of aluminum and lithium came on stage to articulate, what was their strategy. And I was struck. I didn't realize, but Jerome, is relatively new to Rio. I think he's been there 3 or 4 years, but he was at, big companies, prior to that. He is responsible for aluminum. He made some analogies of aluminum to lithium, which is kind of different from, iron ore to lithium analogies that we've heard in the past. He did not. They previously said earlier this year that they would make some announcement by the end of Q2 about what would happen in Quebec, but they punted on that and said, sometime after the summer and before the new year, they'll make an announcement. I think it's highly likely they'll go through with Galaxy mine, the former James Bay mine, rather than Whabouchi, in Bécancour. But broadly, he said by 2028, I think over the next kind of 2 to 3 years, he expects to grow to 200,000 tons production, 2/3 of which will be Argentina and 1/3 of which would be Canada. So that's a very significant number for Canada, if that does indeed happen. And we're fans of Canada. We're fans of Argentina. He did say that Argentina is the cornerstone of their business. And of course it is, because that's what Arcadium largely has been historically. But my sense is that, like, Arcadium, Rio bought Arcadium. It was the former CEO who bought it. And then Paul Graves, who was Arcadium's CEO, stayed on for about a year. But there's some lament. There's like, what is their strategy for lithium? And there was some worry when the new CEO took over, and an iron ore lifer, at the company, would look at lithium differently. That's not the case. It remains one of their 4 key pillars. But I think Rio Tinto under the old CEO had a strategy. Arcadium had its own strategy, and now there's a new CEO. So there's a third strategy, and that third strategy has not yet, been fully articulated. But he did say, like I said, 2/3 are Argentina, 1/3 Canada. And he also said they've made some acquisitions in Chile, but he labeled Chile as like optionality, for the future. So Rio's committed. It's great. Big mining has come into, big chemical or medium-sized chemical space. He did say it's the fastest growing of all of their businesses, and they have iron ore, copper, and aluminum. So it's faster growing than all of those, and will attract the most investment across those businesses, which I thought was pretty meaningful. But he's not focused on market share. He said it's not like growth for growth's sake. I think he's still learning, consolidating, but they're committed. And I think that's good, because this industry, as we've seen, has big cycles every couple of years. And Rio has the balance sheet and the mentality across its business to see through cycles. So it's good. But I'd like to see, it's all about execution. But in particular, I'm curious as to what he articulates about Quebec. And he did say Rio is I think the biggest operator in Quebec. They have a lot of aluminum assets there, and I think titanium and some others. Maybe some of those are for sale, but they are the biggest investor in that province. So they have a lot of credibility and experience. And I think it's good for Quebec hard rock, to the extent that it's interesting. Rio Tinto is huge in the Pilbara iron ore, all right, but they're nowhere in the Pilbara, or Western Australia at all in lithium, and here they are. Like, we made some comparisons that Quebec could be like Western Australia, but this, is it more like iron ore, or is it more like aluminum? That's a narrative and a thought process that I'm beginning to think through a bit more. You made some comments, Matt, last week about what you heard from Aramet. So I don't think we want to repeat that to any meaningful degree, but I would encourage all viewers to watch the DLE video and hear from Fabian, because that is like a nice success story, it looks, in Argentina.
Yeah. I mean, I don't think we should regurgitate those comments. You can obviously hear them in last week's recap. But I think, the thing that stood out for me is that there are no shortcuts in the DLE space. But the early movers in the DLE space who've been at it now for 5 or 6 years are starting to come to fruition. Aramet was the first one, but there's 3 or 4 companies behind that who are in construction or near to be in construction, where we should start to see data points coming out over the next couple of years. And I think that's very relevant from the point of view of lithium supply in general and DLE in particular. So there'll be lots more data points than just Aramet coming up, I think, in DLE land.
Yep. Yeah, for sure. One additional point that I forgot to make that I'd like to make is among the big producers in the world, there is a sense that you need to be in both hard rock and brine. So Rio Tinto, mostly brine, but he did make comments that you need to be a player in hard rock. And I think, some of the hard rock players over time we'll see value, in that. I think Liontown has made some comments about that, but I think if you want to be a true player and, over time, a producing player, you will see both hard rock and brine as being important to be in their portfolio. So I expect over time, I think M&A is likely, as the market has improved, and the balance sheets of a lot of these companies have improved. And if you look at these dips, the value of some of these things on the scoreboard are cheap relative to their history. Rio Tinto obviously made a counter-cyclical bet in Arcadium, but I think you might see more consolidation among, mid-tier players. And so that's just a comment I would
Yeah, I
make.
mean, obviously, if we come back to beating our heads on the table, or maybe our hands on the table, either of those. But I'd have to say that some of the traditional conventional brine players look ludicrously undervalued in the current market. Particularly now that lithium prices are perhaps taking a pause, a flat range bound within that. When lithium prices are increasing, sure, some of the hard rock spodumene developers tend to outperform. But when lithium prices are flat at sort of current levels, I've really got to say that I think some of the brine producers look ludicrously undervalued. Prices around about $20 to $25 a kilogram, and they're generating such significant cash flows at these prices. It's crazy to see some of these market values in the scoreboard and other data.
I want to take on that point and connect it to something, and a bit of a, it is a client of ours that I will, reference this for. But I was listening to the Money of Mine podcast with Ken Brinsden. I'd encourage all of our viewers to listen to. He is now at PMET, but formerly of, PLS, Pilbara, and before that, Iron Ore. So it's an hour and a half discussion that is well worth listening to for a whole host of reasons. But one thing, as I was listening to it, as I was getting my Tesla, serviced for a bike rack yesterday, it came to mind. I was listening to this. He said, in the downturns, he said, it's so easy for exploration companies and mining companies to get scared off. But if you're confident in the resource and you're confident in the team, you have to persevere, because your day in the sun might only be a very short window. If you don't have your project ready, if you don't have the money in the bank, you don't even have a ticket to play. So he said, stick to your strategy, be deadly serious about progressing your project. Don't be scared to spend the money to advance it through the cycle. If you've got the right strategy, the right team, and the money in the bank, there's every chance you'll have your day in the sun. As I was listening to that, I was thinking of JP and Galan and how much flack he got throughout the cycle for just spending the money, to fill the ponds, pursuing the lithium chloride strategy. And now they're, in production, on the verge of commercial production in a couple of months, and potentially very significant cash flow with their lithium chloride strategy, with very high payabilities, relative to, carbonate, and without having to invest, so much, in the plant to get to a battery, grade carbonate. So would strongly encourage everyone to listen to, the two interviews we've done with Galan now in the past kind of couple of months. Full disclosure, we're, advisors to and hold equity interest in the company. But that comment from Ken about just have confidence, because he lived that through PLS, if you remember, right? There were times where people were saying just like shut down, right? And he didn't shut down the PLS mine. He went to a staged production, in the downturn. Unfortunately, Altura, there was a discussion there about what happened there. Altura wasn't able to scale their production because they had more onerous debt requirements and a less good balance sheet. But he didn't shut down. right? So they managed through the down cycle, as has, Galan. And I think their day in the sun, will come. And you were just talking about how cheap so much of the Argentine brines are. If you look at the chemical producers, anyway, we like Galan a lot. And
I think the other point that you make there about Altura is very, very important as well. I mean, so many there is a move these days for developers to gear up, to take on debt, to take on project debt for development, and there really is a sweet spot in terms of taking on debt. For me, it's below 50%, debt to equity levels, and I always get quite worried about companies that take on more than 50% debt to equity levels, particularly development companies, because 90% of the development into production companies I've seen have failed because their debt was too high and they weren't able to service it. And that was exactly what happened to Altura, and it's what's happened to many other development into production assets over the course of my 20 plus year career. So I think, it is really important when you're looking at exploration development into production assets, that you check over the balance sheet of these companies, because, for instance, look at Galan. They managed to get into production, with only primarily equity. You've got another number of other key development assets out there again who've managed to do it with only equity. And maybe we criticize the management teams into the down cycle for diluting us, but maybe sometimes it's better to be a little bit diluted than lose it all to a company going into administration.
Alevra is another example of that, right? Sayona did a lot of financings and then merged with Piedmont, and they've never had debt. And, their prices recovered very significantly. Another company, Argentine brine, is Lithium Argentina. They've had some debt, but not too much debt, but they have built their business in partnership with Ganfeng. We managed to catch up with the CEO, Sam Pigott, and President Alec Michael, at the conference, and very impressed with that story and the production of that. It's sitting there. It's just been bouncing around at a 1.3, 1.4 billion market cap. But when you think about,
that's another asset, and you look at that asset and you go, well, their cash costs are coming up to, or coming down, I should say, to their target level. That's generating massive amounts of cash flow. I think they repatriated the first amount of cash from Argentina in the previous quarter. They've got the PPG asset that doesn't really seem to be being valued by the street. So, for me, that's another company that the valuation looks a bit screwy at the moment. And again, not advice, do your own research, but to me, that looks like a story that's not really being appreciated by the market.
Yeah, and there has been talk in the market that they're looking for some outside investment in PPG. So if and when a transaction occurs to finance that, it'll be interesting to see how strategics value that asset versus how Mr. Market is valuing that asset.
Is Mr. Market valuing that asset at all? Because that's a huge asset. That's 100,000 ton per year asset. And you look at all of the other companies in the industry that have got 100,000 ton per year assets, and they're companies like Albemarle and SQM, and I don't have the scorecard in front of me, but their market caps are multiples of what Lithium Argentina's is. So you do sort of scratch your head and go, well, they've got fine a minority share, but a large minority share in that asset. It doesn't seem that the market's really valuing that at the moment.
No, it's not. And I think that's why they want to list in Australia, or will be listing in Australia, who understand the China market and Ganfeng better than U.S. investors, and also I think are a bit more comfortable with companies that have minority equity interests in their projects, similar to IGO, for example. But lithium, again, we've mentioned it before. I'll mention it again. Argentina under Milei is much better than it's ever been in any time that we've watched this. And just one important factor of that is the ability to repatriate money out of the country. And that is what, Lithium Argentina has been able to do as they're now generating, meaningful cash flow. Okay. I put out a number of other tweets, which will just flash up here quickly. I don't want to go too much into detail, but CATL, the chairman, I think was interviewed there. What stood out for me is that he said ESS will be as large as EVs, probably by 2030. Right now, it's about 80-20 EVs to ESS. He expects that to be 50-50. Driven by AI data centers and grid storage. He sees LFP continuing to take share. The performance is now close to NCM. Sodium-ion, is moving into commercialization, but will complement, not replace lithium. So China's biggest advantage isn't low-cost labor, it's vertical integration, spanning mining, refining, materials, cells, packs, and recycling. I think that's an important takeaway. They're the biggest battery manufacturer in the world. Tesla, is a battery company. They're vertically integrated. But SK Innovation, Panasonic, Samsung, I think they could be more vertically integrated. But also domestic scale comes first. China has a massive home market, that enabled cost optimization, before they expanded globally. So, Western battery supply chains are achievable, but cost competitiveness remains the biggest hurdle. But I think the message for Western battery supply chains is that you need a big domestic market and you need to be vertically integrated. Anyway, that's my take from CATL. It's not every day we get to hear directly from CATL. He spoke English, without much accent. So I don't exactly know who he is, but I don't know. What do you think about that? There's a lot of talk, like CATL is always talking down the lithium price, or there's rumors, sodium-ion, but he seemed to be a straight shooter in his
kind
comments.
of preaching from the same hymn sheet as me. I mean, there are 3 or 4 points that you mentioned there that are, things that I've been saying for a while. So, the most important of which obviously is that EVs and ESS could be balanced by 2030. That's a key point of my demand forecast for batteries and lithium. The vertical integration of the Chinese market, I think, is a key takeaway. And also for me, that sodium ion isn't a competitor to the lithium ion. It will be an additional technology to lithium ion. So, for me, those are the key takeaways. And I agree, it was a very good presentation. I think he's the general counsel for CATL. So he was, and he's worked for a number of law firms, and I think he's actually worked in the West. So it was a very clear presentation on what their strategy is, and he was quite. I thought he was quite forthcoming in terms of the questioning. He didn't sort of prevaricate or hide his opinions in any way. He was quite clear. So it was very good to hear from them, I think.
I completely agree. And one of their vertical integration in the past was with PLS. So I'll also point out, and I'd encourage viewers, we'll put a link in the show notes to this video of Dale Henderson, gave a presentation which had a constructive framework for thinking about the future of lithium supply. He's forecasting 4.9 million tons by 2040, so 14 years. But that's an additional 3.3 million new LCE tons. That's equal to roughly 26 Pilgangoora-sized mines, and there are not many mines that are as big as that. But his argument was that lithium was not scarce, but the scarcity in lithium is what he's calling investable tons, tons that can attract capital, get built, survive cycles, and plug into chemical supply chains. So he's basically saying capital is available, but it's more selective, favoring quality assets, proven operators, strong balance sheets, and durable customer, and government partnerships.
And for me, sorry to interrupt, but that comes back again to the brine plays, because some of these brine plays in Argentina and Chile, they're huge assets, they're scalable assets really easily. If you can add DLE in to reduce the amount of groundwater that's used in the area, you could scale these assets up really quickly to sort of 50, 100, 150,000 tons a year. And finance that mostly out of cash flow and debt without really having to come to the equity market. And again, that highlights, the importance and quite frankly, the scarcity value of some of these brine assets.
Okay, well, let's see if Rio Tinto could scale as fast as that, or Eramet can scale. I mean, Eramet was saying,
I'm not holding out my hopes for Rio Tinto scaling fast. Not noted as a fast mover in general performance.
Me neither. But even Eramet, who has a 150,000 goal, that was kind of like far in the future. I mean, they're talking, I think, going from 24 to 30. Oh, maybe 50, by 2030.
Yeah.
So, they can grow long term, but, but yes, those are investable tons, Eramet's deposit, Rio Tinto's deposit, to PLS's point, right? And this is reflected on the scoreboard, which companies have projects, which companies and projects, right, are investable tons, right? You could have a good asset, not great management, right? That doesn't always happen, right? There'll be a management change, right? Or it'll get consolidated. But, there are lots of projects that are in companies on the scoreboard that still have, sub 100 million market cap companies, and they've been around for 15 years. And there are new ones, right, who are well capitalized, like Q2 Metals, at their stage of development, Surge Battery Materials at their stage of development that, in the case of Surge, have attracted now Brian Pace Braga, and Graham Harris, the chairman, has, been a proven value creator in terms of merging his businesses with Lithium Americas in the past. But I think there's, what are investable tons, I think, is an interesting framework, to think through. And there's a lot of good Western Australian assets. I think you would argue that, Western Australia are investable tons because they have the skills, they have the direct line to China, and they have a good, from a sovereign risk perspective, are great. Okay. I don't know if there's a couple more videos that are coming that Benji is busy editing. You moderated a panel, Matt, on the missing middle. I moderated a panel on the midterms, as well as a fireside chat with MP Materials. Matt, I think you're going to be away next week, so we're not going to have a rock stock recap, and I might be away. I will be away.
Everybody gets a break from us for a couple of weeks.
So I'm not sure. I can't guarantee there'll be rock stock recaps next week or the week after. There might be. We'll see how we go. I do have to thinking about my next Lithium Bowl, which should come out as a newsletter, but we'll just suggest to all of our viewers that you stay tuned for all this additional video content that will come out if the Rockstock recaps don't, because we have been consolidating a lot of content and putting it out on YouTube and Spotify and Apple Podcasts. Before we conclude, Matt and Ben, I think you've been working on a couple of things in connection with our Patreon and battery materials review service. And just a reminder, last quarter we published Matt's quarterly battery materials review in both written form and a 30-minute video presentation for free. But this quarter it will not be for free. But if you're interested to understand, what is in that. We'll flash up the video from last quarter so you can kind of get a sense of what materials involved. Again, at the $150 silver tier, you get the written battery materials review, you get the formal presentation, but that formal presentation is also combined with a group call where you could ask questions and participate in that proprietary, dialogue. And again, at the $250 tier, you'll get quarterly one-on-one conversations. So Matt and I and Rodney, we put a lot of information in the public domain for free. These paid for tiers give you access to things that we don't put in the market for free and are worth. We're very happy to say, I think we got another 10 or 15, silver and gold sponsors have signed up, just in the past couple of months since we reinitiated this program. So we would encourage all of our viewers who can afford and have interest in digging deep into this pullback that we've seen in the market. Actually could be a really good opportunity to test us as if we're right about the predictable seasonality. July and August will be a good time to kind of position yourselves for what hopefully will be a nice upturn in the fall. So with that, thanks Ben and Matt for reminding me about that service offering, and wish all the Americans in our audience a happy 250 year anniversary. I'll be celebrating watching the fireworks from my couch in my living room. So with that, have a good weekend.